Hi everyone, welcome to Money.Finesse.Mindset, episode 4. The Richest Man in Babylon was first published in 1926, and its core principles on personal finance are timeless. One idea the author emphasized repeatedly is this: make your money work for you. To do that, you need to understand investing. Otherwise, the cash you are holding will slowly lose value, thanks but no thanks to inflation. The only way to preserve and grow your wealth is to find solid investment opportunities. That's right, you've got to make your money work for you. If you look up the word invest in a dictionary like Merriam-Webster, you will likely see it defined as to make use for future benefits or advantages, or to commit money in order to earn a financial return. But you know the saying, no risk, no reward. So let's look at how Merriam-Webster defines risk: the possibility of loss or injury, someone or something that creates or suggests a hazard, the chance that an investment such as a stock or commodity will lose value. That third definition really completes the picture. Too risk averse, and your money is just lazying around, not working hard enough for you. Too risk taking, and your wealth may crumble with just a slight shift in the wind. You probably know what I'm about to say. It's like the Goldilocks rule. You need to take on calculated risks so your portfolio can prosper over time while also building enough resilience to survive financial storms. It's all about balance. My investment strategy is simple. I buy a stock or mutual fund and hold on to it. I don't stress over the market's ups and downs. I just ride the waves and give my portfolio the time it needs to grow. I believe that no matter how rough things get, even during a crash, the stock market will eventually bounce back and climb even higher. Time matters, patience pays off. Since I'm in this for the long haul, the last thing I want is to be forced to sell my stocks or mutual funds. That's why I keep part of my portfolio in 3 extremely low risk investments: high yield savings accounts, certificates of deposit, and I bonds. I call them my 3 musketeers. Let's talk about high yield savings accounts and CDs first. Both are offered by banks and credit unions, and both let you earn decent returns. The biggest difference between the two is flexibility. With a high yield savings account, you can deposit and withdraw money at any time without penalty, but the interest rate can change at any time too. In contrast, a CD locks up your money for a set period, typically ranging from 3 months to several years. You cannot add more funds to a CD. You will need to open a new one. Most CDs don't allow early withdrawals unless you are willing to forfeit some of the interest you have earned as a penalty. While your money is locked up, the interest rate stays fixed for the entire term. So how do banks and credit unions set their interest rates? They look at the federal funds rate, or the Fed rate, which is the interest rate financial institutions charge each other for short-term loans. When the Fed lowers the rate, it encourages spending and investment. When it raises the rate, borrowing becomes more expensive, which helps reduce inflation. Now, let's look at this chart showing the Fed rate over the past few years. Notice how it started to decline in 2019 and dropped to 0.25% for nearly 2 years during 2020 and 2021. High yield savings accounts and CDs were not as popular then because of low interest rates. But things changed when inflation started rising during the COVID-19 pandemic. To fight inflation, the Fed gradually raised the rate, bringing it to 5.5%. After inflation was under control, it began cutting the rate. As of March 2025, the Fed rate stands at 4.5%, making high-yield savings accounts and CDs still quite attractive. Here are 3 things to keep in mind when considering these types of investments. Shop around. Some banks and credit unions may offer higher interest rates, but they come with strings attached. Check both the interest rates and the terms and conditions for the best deal. Make sure to keep your money in insured financial institutions. High-yield savings accounts and CDs are low risk only if they are offered by government-insured banks and credit unions. Be cautious of those promising great returns. Verifying if they are insured is just a few clicks away. I will include the links in the description below. Don't put all your eggs in one basket. FDIC and NCUA insurance cover up to $250,000 per depositor per financial institution. If you have more than that, spread your money across multiple banks and credit unions for full protection. I-bonds, my third musketeer, are issued by the US Treasury and are extremely low risk since they are backed by the government. What makes me love them so much is their excellent protection against inflation. How? Well, their interest rates adjust every 6 months. If inflation is high, the rates can be incredibly attractive, as you will see in a moment. Better yet, while interest from I-bonds is subject to federal income tax, it is exempt from state and local taxes, a treat you cannot get with interest from high-yield savings accounts and CDs. I-bonds pay interest based on their composite rate, which is a blend of two ingredients, the fixed rate and the semi-annual inflation rate. The fixed rate stays unchanged throughout the life of the bond, which can last up to 30 years. The semi-annual inflation rate is evaluated every 6 months on May 1st and November 1st, based on the Consumer Price Index for all urban consumers. When inflation is high, the composite rate rises, but if there's no inflation or even deflation, meaning negative inflation, the semi-annual inflation rate is set to 0%, which makes the composite rate the same as the fixed rate. Let's break down how the fixed rate and semi-annual inflation rate impact the composite rate. For I-bonds issued between November 2024 and April 2025, the fixed rate at the time of issuance was 1.2%, and the semi-annual inflation rate was 0.95%. Combined, this gave a composite rate of 3.11%. That's decent, but not quite the incredibly attractive rate I mentioned earlier. To see what I mean, let's look at I-bonds issued between May and October 2019. This chart has 3 lines, green for the fixed rate, purple for the semi-annual inflation rate, and dark blue for the composite rate. These bonds had a fixed rate of 0.5%. As inflation began to rise in May 2021, the semi-annual inflation rate also increased, which drove up the composite rate. By May 2022, inflation hit a new high, pushing the composite rate to a stunning 10.14%. While the rates have dropped since then due to lower inflation, there's always the possibility they could rise again, and that's exactly what makes I-bonds so appealing. They adapt to inflation beautifully over time. Like any investment, they come with a few rules to keep in mind. If you withdraw within the first 5 years, you will lose 3 months of interest as a penalty. And while I-bonds are great, I do wish the US Treasury would raise the annual purchase limit. Right now, it is set at $10,000 per person. Fair enough, but I wouldn't mind seeing it higher. Currently, about 10% of my total portfolio sits in high-yield savings accounts, CDs, and I-bonds, while the rest is in stocks and mutual funds. Since I retired early, I cannot access my 401k or IRAs without penalty until I turn 59 and a half. Plus, as a firm believer in value investing, I plan to hold on to my stocks and mutual funds for as long as possible. That makes my safety first musketeers even more crucial. I'm relying on high-yield savings accounts and CDs for immediate and short-term cash flow. This cushion will help me survive a recession, lowering the chances of having to sell my stocks and the mutual funds at unfavorable prices. As for I-bonds, while their composite rates are respectable, I count on them to deliver strong returns whenever inflation rears its ugly head. Of course, there are plenty of other low-risk investment options, such as money market funds and municipal bonds. Furthermore, apart from I-bonds, the US Treasury also offers a variety of other products, such as T-bills, T-notes, and T-bonds, all designed with safety in mind. Having the 3 musketeers in my portfolio makes me sleep better at night. knowing that I have a buffer in place to help me weather economic gyrations. To me, 10% is enough right now, but of course, my risk appetite may change later on, so I may tweak and realign the holdings accordingly. Ultimately, my goal is to maintain a healthy balance between risk and reward. So, what about you? Do you include any low risk safety first choices in your investment strategy? Drop me a comment and let me know how you allocate your portfolios. See you again soon.